And welcome to the Aaron Katsman Show. I'm your host, Aaron Katsman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below if you've not yet done so. Please go ahead and subscribe to both the YouTube channel and to the podcast. And if you think somebody may find this of interest, why don't you go ahead and click the share button below and you can send it to them as well. So I was reading an interesting article by Ben Carlson of Ritholtz Asset Management, where he does what he does every year. And he says, I'm going through my annual tradition of updating historical return data now that we've turned the calendar on another year, right? He goes back nearly 100 years, 1928, and divides things up by asset classes, how things have performed on average over the last 97 years, where you have, and he uses stocks, gold, bonds, housing, cash, and versus inflation. So first of all, it's important to realize, even though people are complaining about how high inflation has been, we're not so far off of historical norms. Historical inflation's been around 3% plus minus. So while the last couple of years saw higher inflation, with inflation actually starting to get under control, we are getting back to even under historical norms. The other thing which is important to note is that many of you believe that housing, real estate, is the best performing asset over time. And the fact of the matter is, that's not true. Over the last 97 years, housing has given an annual return of about 4.2%. Better than cash, a little bit more in line with bonds. So it's very, very interesting. In fact, there hasn't been a decade where the average annual return of housing was double digits over the course of the whole decade. It's consistent and it's almost always up, except for in the 1930s. Every decade since the 1930s has shown positive returns in the housing market, which can't be said, for example, with gold. Gold, which is all the rage, metals, which are all the rage right now, is really, really hit or miss. Either it's on fire or the opposite. So, take the move in precious metals with a grain of salt right now, because historically that tends to be followed by some leaner years, which brings us to stocks. If you count back to the last 10 decades of stocks, we have had 2 decades where stocks were negative. In the 1930s and then in the 2000s, when the dot-com boom busted, the bubble popped, and of course 9/11, where we had what's called the lost decade. But other than that, returns have been stellar in the stock market. In fact, we've had double-digit returns over the course of a decade, more times than we haven't, believe it or not. Which means what? What does all this mean? Well, it means, first of all, that to do well in investing, whatever that investing is, whether it's real estate, we want to buy bonds, stocks, whatever it is, you have to be in it for the long term. I'm not saying you have to be in it for the 97 years. but what we see from these numbers is that if you hold over, the course of a decade, over a course of 2 decades, you'll be rewarded pretty handsomely no matter how you're investing. But again, king investment is in the stock market, without question, which leads us to something else. I had a call recently with somebody who's starting to invest, and they wanted to know, how do I analyze individual stocks? Should they go the route of individual stocks? Should they go the route of ETFs? How to buy an ETF? So what I said is the data suggests, and we've spoken about this numerous times, that trying to buy and be successful trading individual stocks is very, very difficult. It's much, all the data points to the fact that if you just buy the market, right, whether it's the S&P 500, the broader market, statistically, you have a much better chance of doing well than if you're trading in and out of stocks. Most fund managers, professional investors, are unable to beat the index. So What does that mean about, Joe and Marge retail investor? What are their chances? They don't have staffs of analysts. They don't have all of that. So what are the chances if the people with the analysts can't beat the market? What are the chances that, retail investors are going to over time beat the market? Very, 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 very small. The next question is, well, how do I buy an ETF? What should I buy in an ETF? Should I buy sector ETFs? Should I buy broad-based ETFs? So I said that I believe that, again, there's no right answer here, but my philosophy is to stick to broad-based ETFs. Why? Because I believe that if you're going to put your money into a sector ETF, you're doing the same thing as trading stocks. You're making a bet. You're saying, you know what? I'm smarter than the market. I know that AI, or I know that utilities, or that financial services companies, consumer discretionary, whatever it is going to do better than the broader market. And as the data shows, right, most people are not able to make that call significantly or statistically with any kind of success. You might get it right once in a while, but that doesn't mean that over time it's beneficial to do that, right? So I believe, like I said, I've said this a lot of time, right? Broad-based ETF, whether it's total market ETFs or just go, large cap, mid cap, small cap, international, emerging markets, whatever it is, you want to have a diversified portfolio where you're not making bets, because again, once you start making bets, the data is against you, whether it's an individual stock or a sector. You're still saying, I know what's going to do better. And we've shown over the years, over the decades, we can't do that. Most statistically, you don't know what's going to happen. Where's salvation in the markets is going to come from? We never know. Nobody thought that all of a sudden silver was going to be the best performing asset, right? There are a few people out there, right? The gold people, the metals people, yeah, but they're saying that every year, right? So they finally got it right. But how much money have they left on the table over the last 3 decades, pounding the table on silver and gold? They left a lot of money on the table, I think. So it's important to not make bets. Now, you might want to take part of your portfolio, a small part, if you think it's interesting, right? If you want to educate yourself about how to analyze things, or if you already know and you think, you know what, I have an idea here or there. I don't think there's anything wrong with taking 10%, 15% of your portfolio and putting it in individual stocks. Again, you might lose some of the efficiency, but there might be more to life than that if it gives you some pleasure or it keeps you busy in a good kind of way. So go for it. Why not? But to put all your money into that kind of a strategy, I don't think it's so. The data says that's a big mistake. So think about that. Okay. The most important thing is to invest, right? How to invest? Well, the data says, real estate's not bad. Gold, metals, like I said, hit or miss. Bonds are consistent. You'll do better than cash, but not significantly. But if you really want to grow your wealth over time, decades, and it's gone back for 9 decades, right? Nothing has really beaten the stock market, believe it or not. Again, especially coming from Israel, where everybody believes that it's all about housing, right? But statistically, housing's been great. It's had its peaks and troughs. Nobody seems to remember when things dropped, when things are going gangbusters. But things do drop, and they can drop severely, even in Israeli real estate and in the stock market, right? Whenever you're going to invest, you have to be prepared for potential losses. Nothing's a guarantee, nothing's a lock. But the longer your time horizon, the more success over time you will probably have. Not guaranteed, but you'll probably have, because that's what happened historically, right? We have to learn from history that, in fact, investing of any kind, but investing, whether it's real estate, whether it's in the stock market, should be with an eye towards the longer term. Time is your friend in this business. And the more of it that you have and the more of it that you give over to your investments, the data says the more successful you will be. You've been tuning into the Aaron Katsman Show. We speak about your life, your money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, shame on you. But you can still, there's still time. There's still time before we close. There's still time. So why don't you go ahead and hit the subscribe button. You can subscribe to both the YouTube channel and to the podcast. And if you think somebody might find this of interest, why don't you go ahead and share it with them by hitting the share button below. Thanks so much for tuning in. And we'll speak to you soon.